Just a quick background issue. Why do banks exist? They basically exist to pool both liquidity and credit risk and allow an economy to take longer-term investments. Somebody wants to develop a residential subdivision and they need $25 million to do that. It's going to take them 5 years to do it. They might have a hard time going to individuals to put that together because they wouldn't want all their eggs in one basket. Plus, they might not be willing to lock up their money for 5 years. Banks can pool money from a bunch of different people through certificates of deposit, etc., and make longer-term investments. There are no healthy economic systems that don't have healthy banking systems. That's why people legitimately get concerned when the banking system is not working well. But there is a dilemma in the banking system. The banks do not have all the money in the bank. They're really dependent on their capacity to liquidate assets. And when they can't liquidate assets, they can't meet their liquidity problems. We had a huge red flag, which the government could have acted on and did exactly the wrong thing with Bear Stearns. When Bear Stearns went down, at least on the surface, they were solid. They had more assets and liabilities, but they had no liquidity. And we hadn't had that happen really since the Great Depression. Banks are leveraged about 10 to 1. They have $10 in debt for every dollar in equity. Investment banks are leveraged 30 to 1. So they have a lot more debt and equity. That's why they went down so fast. The Fed's been actually increasing the leverage in the banking system through my whole career because they wanted to grow this money supply. The SEC encouraged, in a certain sense, after Spitzer undermined the traditional investment banking rules. Investment banks had primarily been taking risk with their clients' monies. They started taking risk with their own money, and their leverage ratios went up pretty significantly. Before there was a Federal Reserve, banks were leveraged about 1 to 1. So that the downside protection in the industry was much more significant. Even conservative banks had to leverage because you couldn't compete against higher leverage competitors. How did residential real estate get into the capital markets? How did that happen? Ultimately, residential real estate prices are determined by affordability. You can't buy a house you can't afford. If you look at the peak of the residential real estate cycle nationally, residential real estate prices were about 30% too high. Now that varied a lot by markets. In Southern California, they were 50, 60% too high. In Winston-Salem, North Carolina, where I live, maybe they were 5, maybe 10% too high. But on average, they were about 30% too high. Bad news. Initially, residential real estate prices nationally fell about 20%. When that happened, since banks were largely financing residential real estate, it destroyed about $500 billion of capital in the banking business. Banks are leveraged 10 to 1, investment banks 30 to 1. Let's just use the 10 to 1. If you destroy $500 billion in the banking system, you destroy $5 trillion worth of liquidity, or $5 trillion worth of lending capacity. That includes the capacity and ability of banks to lend to one another. Banks initially scrambled and tried to raise capital. They raised about $200 billion. But there was about a $3 trillion liquidity shortfall in the economic system because of the destruction of capital through the fall of residential real estate banks. Then the markets realized that we've fallen 20%, but we weren't there. We might destroy another 100, maybe $150 billion in additional capital. That would destroy another $1.5 trillion in liquidity, and the capital markets started locking up. They were still working, but they started locking up. And then an interesting, much under-discussed decision happened that really closed the window for banks. When Washington Mutual, a large thrift, failed out in California, the Treasury and the FDIC decided to protect the uninsured depositors. Traditionally, when a bank fails, they give 100 cents on the dollar for the insured depositor, but the uninsured depositors don't necessarily get 100 cents on the dollar. They chose to do that. The practical implication of that, the debt holders in Washington Mutual, even though they knew they were going to lose money, lost a lot more money than they expected. and the market, in 1 minute, figured out, hey, this is not a fair game. The FDIC makes the rules for banks, and they're going to do what they want to do. So if you're a debt holder in a bank, you're at a higher risk than you would have expected to be. That closed the market for banks, the capital markets. BB&T had been in the market about 2 weeks before this. It was a little choppy market. We didn't have any real problems. Once this happened, no bank could raise any capital. That's why Bernanke and Paulson were a little bit panicky when they went to Congress. Housing was overbuilt in other countries, and international financial intermediaries had invested very heavily in the U.S. housing market. That's how this crisis went international. How did the residential real estate markets fundamentally get into the capital markets? Remember the subprime crisis? That was kind of the beginning of this process. You heard about the subprime crisis. The subprime market, by the way, is nowhere near big enough to tank the U.S. capital market. It's simply not that big. The way it got into the capital markets, however, is the subprime credits, a lot of them have been securitized and sold in the capital markets based on ratings from Standard & Poor's, Moody's, and Fitch. Standard & Poor's, Moody's, and Fitch are government-sanctioned rating agencies. They have an oligopoly. Nobody else can be in that business, and therefore they have a government sanction. And they did a horrible job of rating these subprime instruments. The market quickly figured out that they had done so bad a job that maybe they had misranked everything. Because they were ranking things A's, they were F's. It wasn't just a little. They weren't A's and B's, they were A's and F's. They said, well, boy, these guys may not know what they're doing in ranking any of these instruments. So the market started locking up. And it impacted things you would never expect. One market that was significantly impacted here in Virginia and across our whole footprint and across the whole country was what's called the auction rate municipal bond market. The auction rate municipal bond market primarily supports tax-exempt entities, typically that don't have taxing authorities. Things like hospitals, universities, bridge authorities, airport authorities, and they've issued long-term bonds to finance a new addition to the hospital, often either on short-term interest rates or even being refinanced periodically. And the theory of that was to get lower rates, but there's a risk involved in it. A lot of these bonds were issued based on insurance policies from two large insurance companies, AMBAC and MBIA. These insurance companies had AAA ratings from Standard & Poor's, Moody's, and Fitch. But once the market lost confidence in the Standard & Poor's, Moody's, and Fitch ratings, they lost confidence in the insurance companies, rightly so, because these companies actually were broke, because not only did they guarantee lots of municipal debt, but they had guaranteed lots of the subprime real estate debt. And the market figured that out long before Standard & Poor's, Moody's, and Fitch figured it out. So there was lots of entities that were in good financial condition that couldn't get financing in the market. The hospital in Wilmington, North Carolina, a very sound financial entity. But if you're in Hong Kong and the rating systems fail, you don't have any idea whether the hospital in Wilmington, in North Carolina is in good financial condition or not. Fortunately, there were people like BB&T that we had the liquidity, and we actually did $6 billion of financing for these entities as this capital market collapsed. In fact, liquidity is a funny thing. It was a huge flight to quality, and we were actually buried